Thank you for joining us for today's webinar, where we will be discussing 5 practical steps to a healthier financial future. This webinar is being recorded. All attendees will receive a follow-up email with today's recording and presentation deck within a week. All participants have been muted, so please use the Q&A box for any questions. Your presenter today is Joshua Melander. He is the Business Development Manager and has been with Provident for over 8 years. And with that, I'd like to now hand it off to Joshua. Welcome, Joshua.
Great, thanks so much, Lena. Once again, Lena mentioned my name is Joshua Melander. And we've been doing a lot of seminars like these with some of our employer partnerships with the community. So we're happy to provide this for you. And I'm just going to kind of give a basic overview and just try to direct you and guide you to the appropriate department, either within Provident or around the community, to get some further information about investments or budgeting or booking an appointment with one of our certified financial consultants. So we'll go ahead and get started. This is a 5 practical steps. And we have a 5-step plan where we'll go over some basic information. But really what we're trying to accomplish out of this seminar is, being in control of your money and really getting a starting point of where you're at, and maybe some simple changes, what you can do to improve and reach your goals, whether it's a simple goal or a long-term goal. Your income does not determine how successful you are. Your choices and priorities do. So the first step on this plan is to establish financial goals and priorities. We do have some worksheets that we're going to briefly show on this presentation, and I will email those to all of you at the end of this. But we're really trying to establish a goal or a net worth, so to speak, on where you're at. Identify needs and wants, be specific on the goals, when you will reach it, how much will you need. There are different types of goals, whether it's a short-term goal, I like to say, whether it's saving for a vacation to Hawaii this summer, or some of these long-term goals are more like home buying. Purchasing a home in the Bay Area is a pretty daunting task, but it's not impossible. There are some, if you have a plan and stick with it, saving money from each of your paycheck and finding out, what you can set aside, you could hopefully, through budgeting, you could reach those goals. But then also being realistic. You can't, taking 20% of your income is, to get your goal of buying a home in 3 years just may not be realistic. So you have to look at your own financial priorities and payments that you're just obligated to pay on a monthly basis, and finding out what is realistic to set aside to reach these goals, and may just take a little longer, just depending on what that goal is. So here's one of those worksheets that I briefly talked about. This is a short range goal, mid range, and long range. I mentioned about a down payment for a house would be something that would be more in the long-term goal. This is, for example, taking like a 3-year plan to try to buy a house, and what you would need. Obviously, this is $20,000 is not gonna cut it with with a down payment, but you may need $200,000, $300,000 for a down payment on a house, depending on where you're buying. And looking at how much you could set aside from each paycheck, how much additional savings you may need, this is taking it as going as far as back as each pay period, how much you'll need to set aside each pay period, and then coming up with just a budget and a goal. Some of these mid-range goals could be paying for your kids' high school or college education. There definitely are educational savings account that Provident does work with partners to help you guide. If that is something that you're looking at saving for, that would be a good example of a mid-range goal. So taking stock, this is really where it starts. Provident is really big on the lending business. We're one of the preferred lenders in the Bay Area on home purchases and mortgages. That is really where you're going to get a great taking stock analysis of your own personal picture and how much money you have, taking all of your liabilities and all your assets, and then finding out how much of the money you'd be qualified for on a purchase here in the Bay Area. That's a great taking stock approach that, whether you're buying a home or anything, if you did that same approach to, how much saving for your high school education or college education for your kids, you could really find out where you're at and what maybe changes you need to make to be able to afford something like a high school education or college. And then looks like, okay, I'm just going to keep an eye on the question. If you do have any questions or chats, you can go ahead and put those in the chat. And we'll go ahead and stop if you want me to elaborate on anything in particular. This is another take stock worksheet. So we mentioned this is something that you would go if you were going with Provident and looking to buy a home. They would take your checking account, your investment accounts, your stocks, anything that you have as an asset, they're going to put in this category under what you own. A lot of times, if you are purchasing a home, income could come from other sources other than yourself. If you are married, they'll look at yourself and your spouse. They'll look at overseas accounts. If you have family members, your parents or other relatives that may want to contribute toward that down payment, all of that would count in the what you own category. Also, retire, 401k, all those types of accounts also count toward your assets. And then what you owe would be your credit card debt, your auto loan, if you have student loans, any of that would count towards your what you owe. So essentially what they're trying to do on a home purchase is finding out your assets and your liabilities and figuring out what total amount that a financial institution would be willing to lend you. And Provident is definitely going to look at that, and any lender will as well. So just kind of continuing, this would be, I mentioned, if yourself and your spouse, they're going to look at any other kind of income. They're going to try to be as creative as they can, just to make sure we're not missing anything. There's a lot of different sources of income, and we try to make sure we're giving you a full picture to try to get you the most amount of house you could qualify for, but also being realistic as well. So the second step on this plan is really creating and sticking to a budget. Having goals and aspirations are nice, but they're not realistic or they're not attainable unless you actually have a budget to get there. So this is probably the most important thing is having the budget with your income, tracking the expenses, your savings, your debt, and the bottom line. So with this budget, it really just means living within your means. I think when you kind of do the take stock approach, you may find out you're spending a lot more money on dinner, going out to dinner and groceries and your cable bill and looking at how much you're paying interest on an auto loan. When you really start looking at all these expenses and putting it down on paper, sometimes there could be simple changes. If you're paying 7% interest on a car loan, you could probably get that for 4%. If you're spending a couple $100 a month on groceries, maybe you could take $100 off a month, and simple things like that could help you get to these goals. Some things you may need to substitute, other things you can reduce the amount you're spending, and maybe some things you can forego entirely. So this is a good, we have some of these slides that come from different sources. We've partnered with a lot of third-party organizations to gather some of this material. San Francisco Consumer Credit Counseling Agency is now called Balance. We've partnered with them for various seminars. So some of these slides come from them, and we try to reference them when appropriate, but this is one of those. This is a budget guideline. Everyone's a little bit different, but this is, taking a generalization. This is looking at housing is always going to be one of the biggest pots that your budget's going to be taken up from. Whether you own a home or paying rent, it's going to go into that category. The other is kind of more the unknown. That could be the groceries, the restaurants, the dinner, travel expenses. That could all go into that other category. Debt is 15%, as well as transportation. Transportation, of course, would be mainly related to your automobile expenses, and then savings. So what this is trying to tell you is, with all those expenses you have, the general guideline is they want you to try to save 10% of your income each year, each month, and each paycheck. Whether that's going towards a 401k account or it's going to a savings account, something liquid, could be a liquid CD or a liquid savings account, or just setting aside to some kind of travel fund or your child's education savings account for college. Any of those would count towards that 10% of savings each month. So buying a home, this is really what I mentioned is the most common long-term goal for most people. I'm sure on this call, there's people of various age ranges. So some of you may have owned a home for many years. Others may be looking at buying a home in the next 5 years, or you may be so whatever category you're in, owning a home is always gonna be an advantage because it builds equity. When you're paying rent, there is no equity building. You're just paying rent, and there's nothing to really show for it. So with the home purchase, there's tax breaks, whether it's writing off the mortgage interest. You're also building equity, which a lot of people, right now the interest rates are very high, but people also, if they got in earlier at a lower rate, they're able to take advantage of the equity they built in that house and using that to maybe renovate the kitchen and doing an equity loan, which Provident of course has those as well. But the thing about buying a home too is, you're never stuck. Just because the rates are high now, if the prices have gone down, it still could be an advantage because you could refinance later to get that lower rate if the rates drop. But it's really more about the value, the equity that, potential of equity in the future. That is the advantage. And it's not right for everybody. Homeownership, you only do it if you can afford it. When you kind of do the taking stock and looking at the budget and seeing what is realistic, it may or may not make sense for you. So the third step on this is really reducing debt and avoiding high interest loans. So this is something that we actually have seminars just on this subject alone, but we'll just briefly talk about it. Um, Living a cash only lifestyle, that may be a idealistic goal. We know for most people that's just not feasible or possible. But at as much as you can, using your credit card as a luxury, something that is a benefit, but not something you want as a crux that you're having to fall back on. That you're living without. The most common way to live outside your means is to live with a credit card and the impulse buying and thinking you have the money when you actually don't, and then you get stuck into the cycle of paying just the interest on your credit card statement. And that's when that maybe there's some warning signs there that you're kind of living outside your means if you get into the cycle of just paying the minimum payment and the interest on your credit card. You don't have to live cash only, but if you could use your credit card to pay for all the purchases, get the rewards, but then as much as you can, paying off the balance each month. That is more of a form of a cash only lifestyle. That's probably a little more realistic. As much as you can to pay off your payments each month on your credit card, and then reducing interest. So when you do that, take stock and writing down all of your credit cards and mortgage payments. Really trying to look at how much am I paying interest? Is there a way I could save some interest if you are keeping a balance on those credit cards? How could you reduce some of that money you're paying each month? So this is a great way to do it. And then aggressively repaying your most expensive debts. Typically, that's going to be on your credit cards. We've seen some people have 25% interest on their credit cards, which is very high, and they have $100,000 balance. I mean, the amount of interest you're paying on that is pretty high. So you want to look at that and you want to get rid of that. If you own a home, you could refinance and pay off your credit card debt. Now, mortgage consultants or financial consultants will tell you that be careful when you pay off credit card debt with your mortgage because there's different types of debt. There's good debt and bad debt. If you start taking equity away from your home to pay off credit card, they could take your home or your car, but credit card debt is something that that is not backed by that, which is why it has higher interest. So if you have a lot of equity and you're not in risk of getting underwater by doing that, then it's definitely something you want to consider and could save you a lot of money. But just be cautious of not getting too close to taking too much equity out to pay off credit card debt. So that's something just to consider there, and definitely talk to the experts about that in your own situation. So here's a debt worksheet I briefly alluded to. So this is where you could take people. A lot of people will look at their Comcast bill. We call it cut the cord, where they're trying to save money and go to YouTube TV or different things and save money on their cable bill. But a lot of people don't do that with their finances. They don't look at their credit card or their auto loan. You're probably paying a lot more money. You could save a lot more money if you actually did that with some of those debts. Take your auto loan, put down the creditor name, the interest rate you're paying, what monthly payment you're paying, and the balance you have on that car, or your various credit cards you have. And I think you'd be shocked on how much money you could actually save if you had a better card, a credit card, or got a different auto loan. Um, those simple things could save you a lot of money. It takes a little effort, and obviously we work for Provident Credit Union, so we're going to want to push our own products, which we have some great products that are much more affordable on the interest rate than some of the larger banks. So, but that's something that we want to do, whether it's with Provident or someone else. Definitely pay attention to what interest rate you're paying on all those debts you have, and this is a great way to do it. Whether it's this worksheet or some of the resources that we'll show you later that we have through our financial wellness portal that's free for all of our members. You can get a lot of resources out there to have some of these types of worksheets and presentations to learn more about that. So here's what to look for in a credit card. We like to call it the needs and the wants. A lot of people look at the flashy cashback points and travel rewards, the airport lounge access and trip cancellation insurance and all those are nice, and sometimes they could be very beneficial, but it shouldn't be the reason you pick a credit card or a financial institution's card because of some of those. If you're paying a several $100 annual fee and you're paying 25% interest on the card, really where it has to start is the basics. What is the APR on that, especially if you're carrying a balance on your credit card? Is there an annual fee? Are there foreign transaction fees? This is a common one that people don't think about. A 2-week vacation with a credit card that has foreign transaction fees could easily cost you, $150 to $200 in interest and fees just by using that card overseas if your card doesn't have that. So Provident, of course, does not charge foreign transaction fees, and our cashback card does not have an annual fee. So that's where you want to start. And then if you are looking at making some changes to reach one of those short-term, mid-term, or long-term goals, a 0% APR offer is a simple thing you could take advantage of to save some interest, to start knocking down some of that debt. And then once again, if you have any questions, I know we don't have the speaking feature option open, but please go ahead and put some comments in the chat, and we're happy to answer any questions about your own personal situation or questions. So feel free to use that feature. So we got 2 more steps here. Step 4 is to invest in long-term savings. So this would be the 401k. If your company offers a 401k, if not, there's or if they do, in addition, you can do a traditional IRA account or a Roth IRA. And we have another slide that will show you the difference between the traditional and Roth. But some of these types of products that we offer is really where you want to take advantage of those appointments that we have, which is once again free with an financial investment consultant with Provident. Each of our branches has a certified consultant assigned, and you can book a free 30-minute, 1-hour appointment about things just like long-term savings and IRAs and educational savings accounts and various topics. But once again, this is the category where that 10% is going to come into play of your income, and really weighing the instant gratification against ultimate gratification. This would be more the ultimate gratification where you're really saving towards retirement or saving towards your kids' college education. So there's a 3-tiered savings plan. Provident offers all 3 of these tiers as a full service financial institution. The one would be a short term, which is essentially a savings account. This is where you want to have money that's readily available that you don't have a penalty for taking out. So your 401k, your IRA, your 1 to 5-year CD accounts would not count towards the short term. This is money that you want to have that's readily available and liquid for emergency expenses or just to have. We do offer a CD account with Provident that is liquid. It's called a liquid CD account. So that is kind of a good hybrid account that gets you some of the higher interest rates that you'd get in those medium-term accounts, but without any of the penalties of taking money out early. So that's a good option to look into that we offer. The medium-term accounts, right now, these accounts are very popular with mortgage rates very high, which is on the negative side. The positive is the savings rates are actually very attractive right now. So if you are looking at, some of these products, this is a good time to start investing in some of these liquid savings accounts or CD accounts because there is some pretty good interest out there. And Provident has some great products there. So this would be a 2 to 5 year savings account, whether it's a 2-year CD, 5-year CD, that would fall into that category. The long term is where you will probably want to meet with a certified financial consultant or really invest in your company's 401k to the maximum extent each month and each paycheck. So this would be the retirement educational savings accounts. So this is kind of telling you the difference between the taxed and the tax deferred. Taxed is essentially the traditional IRA. Tax deferred is a Roth. It just means that with a Roth, the interest you're getting each month, each year on that savings account is not taxed. So it's growing tax free versus traditional is you're saving kind of the instant gratification for the ultimate gratification approach here. The traditional is going to be more the instant because you're gonna get that benefit on your taxes for the interest you got that year, and you get to write that off, which is great. The Roth, you're not going to get that benefit on your taxes, but you are going to get it on the long term. And you can see in the harnessing the power of time, the long term is a huge savings with that growth of that investment account. So once again, these certified consultants could go over this in more detail, but this is a basic comparison of the two different types of savings accounts for the retirement. And then once again, harnessing the power of time. Essentially, these slides are just trying to say, hey, don't procrastinate and save now, don't wait. And, if you wait now, versus 10 years, you can see how much growth it's going to have, the earlier you get started with your retirement investment plan. And then, so it looks like I'm kind of, some people are saying the audio is getting muffled there. So apologize for that, if that's the case. So diversify. So this is, once again, where the financial consultants could really go into deeper information and look at your individual situation, but really weighing the stocks, the bonds, the cash, and mutual funds, and coming up with a financial, depending on how old you are and how young. Usually the younger you are, the more aggressive they're going to have your investment portfolio. If you're getting closer to retirement age, it's going to be much more conservative versus the stocks and bonds and mutual funds approach. So that's where the consultant can really look at your situation and find out the best investment approach for you. So here is some of these seminar topics that we have that Provident does offer. So this would be college savings, estate planning, investment stocks, bonds, and mutual funds. There's life insurance and retirement planning. These are all, say, an hour. Sometimes it's not exactly an hour, maybe 45 minutes, just depending on the situation. But we do have a QR code here. You can book an appointment for each of these, and once again, these are free. We're not charging, and there's no obligation to use that particular consultant, or it's really just to try to be a resource for you as Provident and as a community partner and credit union is getting you the information you may need for any of these. We also have some great resources on the next slide for some other free PowerPoints, articles. There's a quiz you can take on your own financial situation, and really kind of sending articles catered to where you're at your life stage and what financial products would make sense for you. Symbol is another partnership we have too. It's essentially a self-service investment program that we offer where you could just kind of type in information and a platform where it's looking at the investment side and kind of a starting point on how could you get started in investing, and more on the novice side, and then if you start there, then you can kind of look into more getting professional help. But this is a great starting point to start looking into investing on your own. So like we said, quit procrastinating, get started. If you're not doing 10%, find out how much money you're currently setting aside from your paychecks, and really take advantage of those retirement accounts, and make sure that you have some savings products that are getting some good interest to help you get some of these short-term or mid-term goals. So the step 5 in our last step here is really to stay informed and empowered. I know this is kind of a quick overview on topics, and But there are some professional resources that either with Provident employees or some of these partnerships that we're paying for your benefit that could really get you from here and get you more empowered with some personal financial knowledge. You by doing this, you're already staying informed and getting up to date. But take advantage of Enrich. Enrich is a partnership that Provident is paying quite a bit of money for to help be a resource for our members. We realize that not everyone can attend seminars like this or get all the information they may need personally through these seminars, but it's a great first step. And then things like Enrich can help you get to the next goal on exactly what you're looking for information on. And we have thousands of articles and presentations there for you to learn what you may want to get more information on. So you can go ahead and scan there and get that. And we will email this presentation to all of you, as well as those worksheets we mentioned earlier. So I'll follow up with that, and you'll have this to go ahead and visit these various sites or book appointments if need be. So that's what we have for this seminar. Really appreciate you joining. I know everyone's busy, so taking 30 minutes or so out of your day. There's a whole slew of references where, once again, this is going to be emailed to you so you can go back. But we mentioned the worksheet. You could scan there to get that. There's the Enrich financial wellness platform with all the articles. They even give away $1,000 monthly every month if you are enrolled with Enrich with that personal financial profile. Just another added bonus they give. It's called a money personality. So they're going to once again look at how old you are and are you married or and take some of those questions and then cater something that makes sense for you. And then when you have that money personality, you're automatically enrolled in that monthly challenge. We do have a virtual branch, an investment consultant. So those are two ways you can book appointments with Provident employees, either at the branch or with an investment consultant. So that's what we have there. And I think now we're just going to, next 10, 15 minutes, if you have any questions, just really open it up to all of you. Hopefully the sound is not horrible and you can hear that. But if you do have questions, now would be the time.
Thank you, Joshua. We have a question. What is considered a high APR for credit cards?
So there are various ranges. So we've done some so I'd say anything over 15%, I would definitely consider higher. I think it really depends. I think now maybe it's more like 17%. If you're over 17%, maybe that's something you could probably knock down if you shop around and look for cards. Once again, there's not like a one size fits all with APR, but there definitely are options depending on what you're doing to get that lower. We we have if you've had a low credit score, or if you've had bankruptcy, or if you just don't really have enough credit, that's usually where your interest rate is going to be much higher. But we've noticed, even just with comparing data with the three large banks, Bank of America, Wells Fargo, Chase, we typically see that Provident and other credit unions are at least 3 to 5% interest rate percentage points lower than what they have on really whatever financial picture you're in. So I definitely would say to look at the difference. As far as the okay, I'm looking at some more questions here. What's the minimum amount to open a Roth IRA? It really depends on what products. I think a lot of that, I would say, book an appointment with one of our investment consultants. And I know there's many options they have to invest as far as retirement accounts. So I would like to defer to that with some of our investment consultants on a Roth IRA or traditional, or and just making sure that they'll look at your situation to find you the best return. Yeah, the interest rate and the APR is the APR is the annual versus the interest rate. So it's they're usually not too far off from each other, but it's really just kind of more the annual versus what you're what you're being committed to on the interest rate. So we always say Provident's always going to compare the APR. So and that's so you want to make sure you're comparing apples to apples. So if you are comparing what you have currently versus what Provident, for example, you would want to compare the APR. So you don't want to compare one with an APR and then comparing the interest rate for the other. So I would just, and you'll have that statement if you go to your credit card account. They will list both. So just I would always go by the APR, just compare the APR versus what the other institution that you're maybe considering is charging.
Great, thank you. If we don't have any other questions, that concludes our webinar today. Thank you all for attending and hope the session was helpful to you. As a reminder, we will be sending you a follow-up email with today's presentation. Have a great day. Thank you.